One of the most frustrating things in trading is being right about the direction of the move, but still getting stopped out on your execution. And when that happens, the question is not always, was my analysis wrong? Sometimes the better question is, was my execution style aligned with my personality? Looking at the 15-minute chart for the overnight session, going into Wednesday, price created the previous day's high, going into the PM close on Tuesday, when the new day opening gap formed with the new daily candle created. Price attempted to reach for that previous day high, broke lower, falling just short of the 930 opening price. The failure to reach that level, what does that show? It shows strength. We have this buy side imbalance, sell side inefficiency on the 15-minute. Price closes above it, using this now again as a reclaimed fair value gap. You can see how it's used here, wicking into the consequent encroachment, just falling short of it. And then price digs higher, going into London, reaching for that previous day's high, and then getting above the 1.25 standard deviation of the previous week range projection. Let's look more closely at the 5-minute chart. Here in the pre-session, we can see after 7 o'clock, price created equal highs above that previous day's high, broke lower, consolidating here, going into 930. You can see in the pre-session, after 7 o'clock, price consolidating above the previous day high, breaking lower, and then going into the 930 open, price immediately manipulates higher, taking out all the buy stops, resting here above the equal highs that formed in pre-session, and folds all the way to the new day opening gap from Tuesday. Now pay attention to where the bodies are closing. You see that? Laying right on the low of the new day opening gap. And if we look at overnight, that Asia low falling just short of 930 opening price, price sweeps all that liquidity with this run here lower. So seeing this, one may form the narrative of a potential reversal forming, seeing how the bodies are closing here, indicating especially going into the 950, the 1010 macro. Dropping further down to the 1 minute, you can see the body getting below the new day opening gap low, but immediately price shows strength with the 950 candle right at the start of the macro, getting back above the new day opening gap here, displacing right through, having no problems there. Now let's say you built that narrative to anticipate higher prices, reaching for the buy side here, this bearish order block, the up close candle here, and going into the macro, you start looking for entries. In this scenario, one of the best case entries that stands out to me is using this down close candle as a bullish order block. Why? The first reason is primarily because it lays over the new day opening gap. So any PD array overlaying a higher time frame key level, that is what you want to use for high probability entries. So this candle here at 949, wicking through the opening price, that validates this as a bullish order block. So you have that change in state of delivery. Now at this point, you could have entered on the next candle as it was wicking through that change in state of delivery there, or at the 951 candle. It didn't quite reach the opening price, but you could use that wick, which is the most sensitive part of the bullish order block, from the opening price here to the high of this candlestick. Now let's assume that you did not use this PD array, this bullish order block for your entry. You simply don't trade order blocks, you don't see them, they don't resonate with you, whatever it may be. So you wait and you see this displacement taking place. After 952 close, you anticipate price reaching for this sell side imbalance, buy side inefficiency, and you want to enter in the upper half of that. Let's say you get filled right at the high. And let's say you put your stop loss at this candlestick's low, right here, just on top of the new day opening gap high, because you anticipate a quick run seeing this displacement, because this retracement hasn't even formed yet. So you see how price is staying in the upper half, closing above, showing strength. You're thinking it's going to make a quick sudden run for that buy side, and then you get stopped out. Does this mean that you're a bad trader? No, but it also does not mean the idea of the trade is incorrect. This is simply a human error in execution. It does not invalidate the narrative, and as long as the narrative is still intact, you can simply choose to re-enter. It simply means your execution was too early, your stop was too tight for how price is behaving, and price simply wanted to rebalance deeper before moving in your direction. And if you take a look more closely, we have this bullish fair value gap here. Where are the bodies closing? Within that inefficiency. So all price did was simply rebalance into the inefficiency with the bodies closing within it. This wick falling just short of the new opening gap high, this one wicking into the consequent encroachment there. The narrative is still intact. Using that bullish order block once again, if you take a look at that. On a 1 minute time frame, this is simply a retracement to rebalance into this inefficiency before the move takes place and price expands higher. So don't feel discouraged if you get stopped out in this manner. Now, what do you do in this scenario? Well, there are 3 real ways that you can handle this type of situation. One, to begin with, you can use a wider stop. So let's say you enter here, but then you put your stop at the low here, below the new opening gap, which is the higher time frame key level. So if price and your narrative is still intact, once it displaces higher, you don't want to see price get below the higher time frame key level. So that's your protection there. And if it does get below that, your stop loss is there set for the insurance to protect you, protect your capital from further damage, because at this point your trade idea would be invalidated. So you have to be okay with the wider stop placement if you enter here, which is a good entry point. You're still in a deep discount, but it's obviously not perfect. The second option, if you're someone who demands perfection, you solely wait until price offers you a fill with the PD array that is overlaying a higher time frame key level, this bullish order block. So you either enter here as price is waking out of the change in state of delivery, if you anticipate that quick displacement taking place, or you wait for a retracement the way price did here, and then you get your fill. Still in the macro, 10 a.m. The 4-hour candle has just formed as well. That way you can have your stop place more conservatively, still intact with the narrative, because your stop placement would still be where it would be had you entered here with a more forgiving stop, below the consequent encroachment of this wick or below the low itself. If you choose to go with this route, and if this fits your personality, you have to be okay with missing moves, because there will be times when price just runs from here. And option number 1, taking this fill, will serve better. But it depends on your personality. Are you someone who's okay with missing moves but only waiting for perfection and demanding that price gives you the perfect fill? Or are you someone who is more forgiving, who doesn't demand the most perfect entries? You're able to give price more breathing room to work with, but you always want to be there to participate in the move. Another option is if you're someone who likes to have tight stop losses and want to make sure that you get a fill. Let's say you enter here, get stopped out here or here for an extremely conservative stop loss in the current volatility that we're seeing. You're going to have to be okay with getting stopped out and then re-entering, assuming your narrative is still intact, because that is going to happen with a tight stop loss, especially in the current market conditions that we're in. So be prepared and be okay with getting stopped out. And as long as the narrative is still intact, you can always re-enter at a deeper discount in this case. This inefficiency here, this order block here, once again, or as price is simply wicking into the new opening gap here, buying in the upper half of it. Now, let's say you find yourself getting too impulsive with the amount of information that the 1 minute time frame has to offer. Because if you look closely, you have this wick, you have this bullish order block, you have this inefficiency here, this inefficiency here, this buy side unbalanced sell side inefficiency here. Price is giving you so much data on the 1 minute time frame. And for your personality, that might result in you being too impulsive. So a very simple solution, if you feel that way, is simply scale to a slightly higher time frame. If we take a look at the same chart on a 2 minute time frame, we've reduced the amount of data by half. So that inefficiency on the 1 minute chart is simply this larger inefficiency. Okay? So now if you enter here, when the 952 candle closes, this retracement back into the upper half of this inefficiency, using that as inversion, you place your stop below this candlestick's low as taught by ICT to use the lowest candlestick in the fair value gap formation. that reduces the amount of data and information that's available to you, so you can make a more sound decision if you're someone who gets impulsive and feel confusion when there's a lot of data present. Now, it doesn't mean that you can never use the 1 minute time frame, or a sub 1 minute time frame for that matter, if you were someone who feels that way. It just means that maybe it requires more tape reading and practice on your end before you get to that level. So you can simply use this and have a wider stop loss, reduce your risk, and not have to worry about re-entries or dissecting all the information that's available to you on a lower time frame. Now, it doesn't necessarily have to even be the 2 minute. You can simply use the 3 minute, which would widen the inefficiency even more. You can see the candle hasn't even closed above, so you wouldn't enter here if that's your criteria. Candle closes at the 10 o'clock candlestick on the 3 minute chart. Next candle opens, retraces just into the high. You'd be filled there. Stop loss placed below this candlestick's low, below this wick's consequent encroachment, below the need opening gap, or below the swing low. But in this case, you can see how much less heat you'd be taking entering simply at the 10:03 candlestick. And if this is the route that you have to take, there's nothing wrong with that. You have to figure out what fits your personality and your style of trading. You have to find out what your flaws are. The only downside is that your stop is a bit wider, your risk to reward may be a bit lower, and emotionally you have to be comfortable sitting through more drawdown. Remember, price is fractal. Price is moving the same way on every time frame. And all you have to do as a trader and the analyst in control is you have to identify your personality and find which style of execution matches that. Am I a trader who needs a wider stop? Am I a trader who needs to wait for the perfect entry? Or am I a trader who can get stopped out and is okay with that and simply re-enter when the narrative is still valid? Am I someone who feels impulsive with a lot of data being present? Do I need to scale to a slightly higher time frame? These are all valid options, and there's no right or wrong answer. But you have to figure out what resonates with you, what you're comfortable with doing, and use the approach that best fits you. I hope this was helpful. If it was, please leave a like and comment. Please leave suggestions for any ideas or topics that you'd like me to cover. Recently, I've just been addressing topics that I see in price actions and I can create lessons out of, which I would find helpful as a trader. So if you have any specific suggestions, please leave them in the comment section below, and I'd be happy to take a look at them. Thank you guys for watching, and I'll see you next time.